Ever wondered why Americans seem to be so good at playing the stock market game? It's a common perception, especially when you look at the charts. The New York Stock Exchange, the S&P 500, they tell a story of incredible growth. And get this, a staggering 61% of Americans own stocks. Compare that to just 23% in the UK, and even lower numbers elsewhere. It really makes you think, are Americans just born with a knack for investing, or is there something else going on? Let's dive in and find out what really makes the US market tick. First, let's talk about liquidity. Imagine a massive, bustling marketplace where you can buy or sell anything in an instant at a fair price. That's the US stock market. The daily trading volume is a mind-boggling $362 billion. To put that in perspective, it's more than all of Europe and most of Asia combined. This high liquidity means it's incredibly easy for investors to move in and out of positions without drastically affecting the stock's price. Now, you might point to markets like China or South Korea, which have very high turnover rates, meaning stocks change hands frequently. But that's often driven by short-term speculation rather than long-term investment. In the US, the liquidity is deep and stable, creating a much more reliable environment for everyone. From big institutions to individual investors like you and me. So, the market is huge, but what about the companies themselves? This is where it gets really interesting. There's a key metric called return on equity, or ROE, which basically measures how effectively a company uses shareholder money to generate profits. According to Goldman Sachs, the average ROE for companies in the S&P 500 is a remarkable 20.4%. That's almost double the average for European companies, which sits at 11.4%, and it leaves Japan's 9.1% in the dust. This isn't just a numbers game, it reflects a core difference in corporate culture. American companies are laser-focused on maximizing shareholder value, often prioritizing buybacks and dividends, which directly benefits investors. This high performance is a huge magnet for capital from all over the world, further fueling the market's growth. Beyond the numbers, there's a unique cultural and structural fabric at play. Americans generally have a higher appetite for risk. The dream of striking it rich is deeply embedded in the national psyche, and the stock market is seen as a primary vehicle for wealth creation. This is supported by a system that encourages investment through things like 401k retirement plans. Then, you have the celebrity factor of the tech giants, the Magnificent Seven. Companies like Apple, Amazon, and Nvidia are household names. Their products are part of our daily lives, which creates a natural entry point and a sense of familiarity for new investors. When you see a company you use every day succeeding wildly, it's a powerful incentive to want a piece of the action. This retail enthusiasm creates a powerful, self-reinforcing cycle. So, are Americans just better investors? The evidence suggests it's not so much about individual skill as it is about the ecosystem they operate in. They're playing on the best-equipped field. With unparalleled liquidity, exceptionally high-performing companies, and a culture that champions investment, the US stock market is built for success. It's a system that not only attracts global capital, but also empowers its own citizens to participate and build wealth. So while individual talent always plays a role, the real star player is the American market itself. It's a powerful combination of structure, performance, and culture that puts it in a league of its own. Thanks for watching, and if you enjoyed this breakdown, don't forget to like and subscribe for more insights.